Well, good afternoon or good day, everyone. Thank you for joining us for this Moomoo presentation today, China Stimulus, Hong Kong in Focus. And tonight we'll be looking at the historic stimulus package that's been introduced by Chinese authorities. And we'll also look at the market reactions, which are also quite stunning, and have a look at what the implications might be for markets for the rest of this year and into next year. Before we get going on tonight's presentation, there's some important information for you to consider. First of all, Moomoo is a registered and regulated provider of financial market services here in Australia. We're regulated by the Australian Securities and Investment Commissions, and you can see our license number on the screen there. The other important point from this screen to remember is that the right investment decisions or trading decisions are as much a function of individual personal circumstances as they are of the markets. And so today, while we'll be discussing market opportunities and potential investments and trades, the decision about whether or not any of the information presented tonight is suitable in your personal circumstances is entirely up to you. We haven't considered your personal circumstances, so you need to, before deciding whether any of the information tonight should be incorporated in your investment strategy. So with that important information in mind, let's move on now to the contents of tonight's presentation. First of all, we'll be looking at the China stimulus package and why it's been introduced and how it's being implemented. We'll look at the market reactions, particularly to the initial announcements from the chair of the People's Bank of China on September 24th and the subsequent market moves that came with that. We'll have a look further at the market impacts and in particular at the volatility this has brought to important markets, including the best performing market this year, the Hong Kong Exchange and the Hang Seng Index. We'll look at that volatility and what it could mean for investors and traders in terms of risk and reward. And then we'll go on to look at what are the potential market opportunities. How can investors and traders who are following this stimulus package and see it reaching into the future, how are they potentially playing them, and what are some of the alternatives for investors to consider? So we'll start by looking at the package itself, the why and the how. First of all, on the why, you can see on this screen growth data from around the world. That is the growth in real gross domestic product or GDP. And you can see there next to it the CPI, the Consumer Price Index, or the main measure of inflation used in many countries. And you can see despite the fact that China has one of the most important economies in the world, its situation is quite different to many of the other countries around the world. And in particular, the strong growth that we're seeing there at 4.75% in GDP. Now, while compared to the rest of the countries in this list, you can see only two even come close to that, and that's Singapore and the United States. While it is exceptionally strong growth in comparison to the rest of the world, Chinese authorities don't see it as enough. They've made a commitment to a 5% target for growth this year, and this stimulus package looks like the way that they will ensure that they deliver on that promised growth. So the key factor in the inflation aspect here is that the inflation in China remains very much under control. At 0.6%, it's well below many of the neighbours, and it gives the authorities in China, both the central bank and other authorities, room to move when it comes to stimulating the economy, because they're not as concerned about potential price instability that might come with stimulus, because inflation is already at lower levels. So that's a real positive for China. It shows the commitment to the growth, and the package that's been announced is very comprehensive. As I say, it was announced in a number of different ways over the week, starting in that week of late September, where we saw the PBOC come out with a number of monetary measures. And these measures appear to be aimed at ensuring stability in the economy and heading off any deflationary pressures that might be forcing the growth rates lower than the target rate. And so the monetary stimulus is very important, because not only does it ease the liquidity situation and give opportunities for many different organisations to do well out of the support. We also saw direct measures aimed at households, and in particular the easing of lending requirements, the lowering of mortgage rates, and these sorts of measures directly help individuals in China, and the idea being to re-inspire the animal spirits in the economy, so that the growth rate returns to the target level and that the economy remains in rude good health. So some very strong measures that came out there too. One of the key questions is, do we have more to come? And to consider that, we've got to look at the historical situation here. There are a number of analysts who've estimated the current stimulus measures announced this year by China at around 7.5 trillion yuan. Now, that's a very big package. And in yuan terms, it's the biggest package ever unleashed by Chinese authorities. However, if we look at it as a percentage of GDP, which is important because the economy in China has grown at exceptional rates for so long, that the expansion in the economy means that the proportion of GDP this stimulus represents is not actually as large as the packages that were delivered in 2020 and 2015. So in growth adjusted terms, this is the third largest stimulus package ever. In the terms of the actual spending of yuan and the commitments to invest in the economy, it's the largest package ever. So it's a very significant measure. And a lot of people have been talking it down, and certainly here in Australia and other parts of the world, we've seen people express disappointment. In my view, that could be a misunderstanding of what's going on here, and why, for example, we've seen the announcement that on Saturday there'll be a presentation from the State Council Information Office, and that will include a speech from the Finance Minister. And it's expected at that we will hear more about this stimulus package. Now, I should stress at this stage we don't have any facts. Nothing official has been said. It will all be released officially on Saturday. So anything that we're hearing ahead of that is speculation or analyst estimates of what might be coming. But expectations for Saturday are very wide. Some people expect no further specifics. And the announcement that was made on Tuesday this week didn't have a lot of specifics. And so for that reason, others are expecting they'll get details of specific stimulus programs on Saturday. And included in that detail is potentially the amounts of stimulus. Now, as I say, this is only estimates and guesses as to what might be coming. There aren't any facts available here, so individuals will have to make up their own minds. But the reality is that we're likely to see, it is possible, according to some analysts, that we'll see a package as large as 1 trillion yuan all the way up to 6 trillion yuan. And now that would be extraordinary. I'm not sure that we could rely on those sorts of speculative talk at the moment, but obviously we'll have to wait until Saturday as to understand what is being announced and if it's details of any packages, how large they will be. But it's quite possible there'll be a strong market reaction on Monday, and investors and traders who are looking at the markets at the moment should potentially bear that in mind, that Saturday's package could change perceptions of this package altogether. And if that's the case, then we could well see, as I say, strong market reactions. So looking at that and the market reactions and melt-ups has been a fascinating business. In 4 decades in the market, I can tell you that this is a rare occurrence. They're not unheard of. It has happened in the past. It often happens in response to announced measures from governments and central banks to support economies, but it's sometimes referred to by traders as a melt-up. Now, we're all familiar with the idea of a meltdown in markets and how damaging it can be when markets swiftly fall, but we get a reverse effect when markets swiftly rise like this. And this sort of melt-up is reasonably rare. As I say, I've rarely seen this in 4 decades of trading financial markets around the globe. Nonetheless, it's not unprecedented, and we do have some guides as to how these can play out. But before we start digging into it, bear in mind, this is the daily chart, and it showed the roughly 2 weeks after the last week of September there, where the market reaction became very important. Now, you can see here that market jump from the lows there to the highs is around 33% or a little higher than that. And that is an incredible move in any market in such a short period of time, in just 2 weeks. The fact that this happened in one of the most important markets and exchanges in the world is even more extraordinary. So these are historic times, and there are reasons why investors and traders are asking questions about this package, because clearly it has already changed market behavior. Now, that chart only shows the first 2 weeks of reactions, but just to put that in perspective, here's the weekly chart. And you can see, despite the fact that we've got that very strong move on the right-hand side of the chart there, it doesn't take us anywhere near the previous highs for the Hang Seng. Now, this is the Hang Seng index on a weekly basis. Each of those candles represents 1 week's trading. And as you can see, the moves that we've seen here take us just back to the levels that we saw in the Hang Seng in December last year. In other words, we're back at a 1-year high, but we're nowhere near the high that we saw in the post-COVID stimulus boost. That's the high there on the left-hand side of the chart. And not shown on the chart is the all-time high in the Hang Seng from 2018. So when we take a step back from the daily chart and take a bit of a longer perspective, we can see that the moves in the market, although they're extraordinary, have not yet returned it to anywhere near its all-time highs. Now, that's an interesting fact, given that there are many markets around the world that are at or very near all-time highs, including the US market. And that difference in positioning is a very important factor in working through what might happen in the Hang Seng over time. Now, that is quite an interesting perspective. This chart was clipped today, and so it's up to date with today's move. As you can see, that little green candle on the right represents just under 4% rise for the Hang Seng today. And that reverses the previous couple of days of weakness, and does appear that the news that there'll be an announcement on Saturday has stabilised markets for now. But it's also quite possible, one interpretation of this, and I should stress, none of us know the future. Nobody can state with certainty what will happen in the market, but what many traders and investors try to do is assess the different scenarios and work out the likelihood of each. Now, it's quite possible that the markets, when they resume trading, could simply fall further from here. We've seen that happen before. But the bluer lines you can see on the chart that go from the low to the high, and then from the high to the next low, show us the magnitude of that big lift, a bit over 33%, or a bit over 6,000 points, and then the subsequent fall of around 3,000 points. Now, those of you who are familiar with a Fibonacci analysis will understand that there are three key retracement levels: 38.2%, 50%, and 61.8%. And that move from the peak just 3 days ago to that low that we saw yesterday is just under 50% of the rise in the market. In other words, if this is a turning point for the Hang Seng again in the short term, we might have seen a 50% retracement, very much in line with Fibonacci expectations, before the market could potentially move higher. So as I say, none of us know the future with any certainty. It's possible the markets could fall further from here. But another scenario here is that the retracement we've seen has corrected that initial sharp upward push, and that the consolidation we've seen yesterday and today could mean that we could see further gains for the market through that previous high. So once again, none of us can say with certainty, but there is a potential scenario that fits very nicely with a technical interpretation of the charts. Now, this also fits quite nicely with one fundamental take on it. And a trader was arguing to me today that the commitment to the stimulus package from the authorities in China is very, very real. But they were perhaps concerned about the very rapid rise in the market. And in delaying the announcement of some measures, they might be looking for the market to back away a little from that very steep and rapid rise before putting in place further measures. And that interpretation fits with the idea that on Saturday we could see further stimulus measures and details given. So that's what some traders have argued is the case here, that while the authorities remain very committed to their stimulus package and the outlook for the economy and the markets in China, that the rapid rise in the market was not sustainable, and that we had to see corrective action before further measures are implemented. Just one theory about what might be coming in the very near future for markets generally, and for the Hang Seng in particular. So one of the aspects of these recent moves is that we've seen volatility lift very high. Now, in markets and in life, there's a direct relationship between risk and reward. And one of the reasons why so many investors prefer share markets over the longer term is because of that risk in the market, the risk that share prices might fall. Because the flip side of that risk is that the rewards in share markets can be greater for investors who are prepared to take those risks. So it's an important thing to keep in mind. For traders, volatility is the trader's friend. Moving markets are one of the best things that can happen from a trading point of view. And I don't need to tell the traders amongst you how attractive volatile markets can be. But it's also well known that many investors are very concerned about volatility, and with good reason. One of the keys to successful long-term investing success is preserving capital. And so periods where the market falls very hard and very heavily are very damaging to the value of a portfolio. And so it's understandable that investors are very wary of highly volatile markets. But it's important to get the balance right. While being aware of that risk in the markets, it's also very important to ensure that the potential rewards that are on offer are not skipped over. And to give us some idea about what's happening with volatility in the Hang Seng at the moment, I've added the volatility measure, a short-term volatility measure, to the bottom of this chart. So you can see that the moves that we've had very recently have spiked that volatility line at the bottom of the chart. It's brought it up to 50% from levels below 20%. I think it was around 14% earlier. So that's a very significant spike in volatility. Now, this is historic volatility. It's a measure of how rapidly the index itself is moving. And that's, of course, distinct from implied volatility, which is a value that's found by reverse engineering options prices. So this historic volatility is tracking the actual price moves, price variations on a daily basis in the Hang Seng. And so that spike cannot be ignored. In fact, it demands respect from both investors and traders in terms of what it might mean for the markets. It means that care is required and that there is higher risk in the market. In fact, volatility, as many of you know, is the key measure of potential market risks and is one of the key inputs to many of the portfolio construction tools that are used by modern day investors. So this spike in volatility is important, but potentially it could be pointing to an increase in possible rewards out there in the market. And that's what we're looking to today. So risk management in investing and trading is always important, but it's particularly important in periods of elevated volatility and something that anyone who's contemplating entering or being in the markets at the moment should bear in mind. So what are the opportunities in the markets? Well, I'm going to touch on a few areas. Now, I stress once again that the right choice for an individual is dependent on their personal circumstances as well as opportunities in the market. So the right opportunity for any individual is up to them. They have to decide in light of their current situation what is the best choice for them. But we'll touch on some of the potential exposures that could do very well. We'll look at the growth exposures because this is one of the keys on the Hang Seng market and around the globe. This stimulus package is important to just about every market. The reality is if the Chinese economy is expanding, is accelerating its growth, that has implications for the whole investment world. So growth exposures generally have been quite powerful. And we'll have a look at some of those on the Hang Seng market. We'll also touch on which are the hot sectors in the market and what's been rewarded so far in the moves that we've seen. And we'll also look at ETFs and the important role they've played in this recent rally. And in particular, we'll be looking at two different kinds of ETFs, index ETFs and those that employ leverage, something not every investor and trader is familiar with, but something that can be very powerful as a short-term tool for generating excess returns. And then we'll have a look at some of the other exposures around the globe, US listings of Chinese businesses and resource stocks in particular that have responded very well to the much improved growth outlook after the announcement of this stimulus package. So I've taken this heat map today to show, I think, one of the most important parts about this, and that is that the rising tide is lifting all the boats. You can see from this snapshot taken this morning, and it's only today's performance we're looking at, that the buying is very broad-based. On the left, you can see the sectors that were performing today, and on the right, the individual stocks. And the point of this is not necessarily to highlight any individual stock or sector, but to show that, first of all, being in the market was one of the most important things in the bounce today, because as you can see from the two pictures here, almost everything bounced. Now, I touched on the fact before that the exposures, growth exposures in particular, top choices when it comes to this kind of stimulus package. And we've certainly seen that playing out in the market. And in particular, consumer-related stocks have done very well. Those that are involved in finance have also done very well. And in that intersection of consumer and finance, we saw the brokers take off. Many of their share prices have rocketed higher as it was thought that this stimulus package could return confidence to investors in China, and that would see a big increase in activity on the market. And of course, it's activity that keeps brokers going and drives their profits. So a big increase in broking activity would mean a stronger profit outlook for those brokers. So a very strong reaction there. But there are many other sectors that perform very strongly. As you can see, traditionally we think of technology stocks as being leveraged to growth. Certainly any resource exposed stocks have been boosted by this news and have been performers. So you can see that we have got a broad-based run, but it's about growth and it's about consumers. And that's where we're seeing the really bright green spots on the daily trading maps. It's also interesting to note, and it's a bit of a trader's rule of thumb, that in a rising market, anything that's not going up is worth a second look. It could be a problem because when the whole market is rising and a handful of stocks are falling, that can be an indication of individual trouble at the company involved or the business involved. And so it's worth examining. It's not a surefire sign, but it's a clue that it might be worth having a stronger look at that particular investment or company. I've mentioned that ETFs have played a very important role in this rally, and this has certainly been the case. And in fact, in those very early days of the buying, amongst the top traded stocks on the exchange were broad-based ETFs. That is, ETFs that track the Hang Seng index itself. Now, they move in lockstep with the index. And so getting exposure to the index might have been an initial reaction from international investors who were taken by surprise. The reality is that there have been concerns about the growth outlook in China for some time. Many investors, international and global investors, had shied away from China exposures, including Hong Kong. And that meant that there was an underperformance in the Hang Seng index. So when this news, very important news, was released, many of them scrambled, and they scrambled to get exposures to China and to the growth story that was coming through with the stimulus package. And the way they did that was to buy index ETFs. They hadn't yet turned their minds and their resources to researching the best stocks to own in this scenario, but they knew they needed exposure. And so they scrambled into the index ETFs. Now, that might be a short or long-term positioning. Clearly, investors, whether they're institutional or individuals, don't know the future, but it does look like the moves really caught out some international investors, and that scramble into ETFs, into index ETFs, was a part of that story. And it's quite possible, going back to this chart here, that any further gains in the market past that 1-year high could be driven by international investors who are underweight. As I mentioned earlier, a number of markets around the globe are at all-time highs, and there's a lot of concern about valuations at those levels and about potential corrections. That's a very different situation to the one that the Hang Seng is facing. Having bounced very strongly, there are concerns about at least the short-term sustainability of that bounce amongst some investors. But the reality is that given the underweight positioning of so many international investors, we could see very strong gains. And as part of that, there will be a rotation out of those index ETFs and into individual stocks if those global investors stay true to form. Now, the reason I've also highlighted this ETF filtering page is that a number of traders and investors looking for short-term returns have turned to the leveraged ETFs that you can see on the bottom left screen there. And if you're an app user, if you're a Moomoo app user and you haven't yet had a look at the desktop platform, I highly recommend it to you. As you can see, you've got tools like this ETF filter, which will not only show you the top gainers, those with the highest volumes and therefore the greatest popularity, but it'll show you things like the top index ETFs and leveraged ETFs. Now, leveraged ETFs are very different to many others. They're designed to mimic the single day performance of that underlying index, in this case, the Hang Seng. Now, they often do so with leverage. That is, they'll deliver 2 or 3 times the performance if it's in the right direction. So you'll also see on the bottom right there that we have inverse ETFs. And these are ETFs that go up in value as the underlying market falls. Now, they can be used for hedging purposes, but particularly if there's leverage involved, there are some quirks to that every investor or trader should understand before they move into them. But the leveraged ETFs can be traded in either direction. So those who are concerned about this market giving up the gains and falling from here, there's a leveraged way to express that view in the market. On the other hand, day traders who are interested in getting involved with the volatility we're currently seeing in the markets can do so in a leveraged way. Now, it's very important that anyone using these instruments understand leverage, and in particular, that aspect of leverage that can not only magnify wins, but magnify potential losses. And it's very, as I say, very important to understand the impacts of leverage and to understand the ETFs that you're trading. But you can find a lot of that information on the Moomoo platform. So very useful tools here for working through some of the key aspects of ETFs to decide which exposures are more suitable to an individual situation. Another approach that I've used is to use a more quant-based approach. Now, some people prefer investment themes and stocks and sectors. Others prefer a more numeric approach, a more price-based approach. And that's what I've used with this stock filter on the desktop platform. On the right-hand side there, you can see the year-to-date performance. And I've filtered for those that have performed worst. And then I compare that to the 60-day performance in the column just to the left. So these are the 2 right-hand columns of the table. And you can see those stocks are all still down on a year-to-date basis, and yet many of them have bounced solidly in the last 2 months. In other words, in the rally that we've seen. And that is a quick shortcut to identifying on a price basis some stocks that might present opportunities. Now, of course, further research would have to be done. This is a starting point, not a finishing point. But this sort of quick filtering can help investors and traders decide very quickly or quickly get narrow in on some target stocks for further analysis. So I recommend this tool to you as well, filtering by year-to-date performance and then comparing it to the 60-day performance is a very quick way to identify those stocks in the Hang Seng index that have rallied in the last in the recent moves, but are still down on a year-to-date basis, and for that reason might present value. So a good departure point and a more quantitative price-based approach, which suits some investors and traders. So we've had a number of questions come through, but before we get to those, I'd just like to go back to this sector spot. We do have, as I say, this was today's performance, but the strong performance that we're seeing is, as I say, very broad-based. And I described it as a rising tide. I suspect that's what we're looking at. And going back to this chart, I see potential for real gains over the course of this year. Now, markets don't ever go anywhere in a straight line. We should bear that in mind. And looking at this chart, although this is pretty much straight line, you can see even in the big run up, there was a down day on the way. So that is natural and normal market behavior. Markets fluctuate. And so those gains that we've seen may not be sustainable, or they may be sustainable. And that's a question that every investor has to answer for themselves. And particularly those who are taking a longer term view. Any pullbacks might represent buying opportunities if the view is that this rising tide introduced by the authorities in China will continue to lift all the economic boats. So potential real positives there from the market. I'm going to go now to some of the questions that we've had come through in the lead up. Please feel free to put more through to us. We'll have a look at some more of those questions. But the first question here, should we invest in technology, commodities or finance? Well, first of all, that depends very much on the existing portfolio. So if an investor already has 2/3 of their portfolio in technology stocks, it's possibly not the best place for them to be looking for additional growth exposures. Now, all of those sectors, the technology sector, commodity stocks and finance stocks, could do well out of the improved liquidity and consumer situation. And so to some extent, there's a toss-up between all three, and taking a diversified approach might be the way to go. But for me personally, I am underweight commodities, and so buying into the commodity sector is the growth exposure that makes the most sense to me. But as I say, that depends on my situation as much as the market opportunities. Will the rally in China's stocks be sustainable? Well, that's the key question that we're seeking to deal with tonight. And it comes down to, well, certainly we'll have more news on this over the coming few days. And on Saturday, when we hear from the finance minister, we'll have a clearer picture of where we're headed, at least in the short term. But my view is that where we've seen measures like this before, there's been extensive follow through. In other words, the Chinese authorities deliver when they put forward programs, and the stimulus that was delivered in 2015 and then again in 2020 was very effective in lifting the economy and lifting the markets with it. So I don't see any reason why it will be different this time. Of course, history doesn't repeat itself, and past performance is not necessarily a guide to the future. But there is real potential here, I believe, for a sustainable rally in the Chinese economy, and I believe that the share market will follow with it. Now, that doesn't mean that there won't be digestion issues, and as I say, markets don't go anywhere in a straight line, so we'll get some back and forth, no doubt. Even if markets are heading towards sustainable gains and the Hang Seng is heading to significantly higher levels, there will be down days on the way. Over the period. And when we, I lost my network connection. I hope I'm back. The volatility spike that we're seeing right now is in keeping with volatility spikes we've seen previously. And it's interesting to note that the volatility spike is the one towards the middle of the chart there occurs after the market starts moving higher. The volatility really increased. And then as those gains were consolidated at higher levels, the volatility dropped away. In other words, the fear was erased from the market, and we saw a very strong gains across the board for the market. So while I say past performance is not necessarily a guide to the future, we have seen situations where volatility has spiked like this, and yet sustainable gains were made across the market. And in my opinion, that is what we're looking at again. So to me, it's a matter of what and when. But if you doubt the commitment of the authorities to lift the Chinese economy, then perhaps you might have some concerns about that. Another question here, should I wait to see consolidation before slower, healthier gains are made? Well, that's a matter of risk and reward once again. There's no doubt that moving into the market at times of higher volatility represents higher risk. There's no two ways about that. However, waiting for calmer waters in the market and calmer trading conditions could mean a lot more gains have already been made. So once again, this is a question for each individual to answer. And it involves not just your current portfolio, but things like, what is your risk appetite? What's the sleep at night factor for you? Can you take on market risk and still sleep well without any concern. So these are factors that each investor will have to decide for themselves. But it's important to make a decision. Not doing anything here is also a decision. And it may be the right one, but it might not be as well. And so, as I say, waiting to see consolidation might mean that any potential gains and have already been realised, and that you might be coming into a market that's 10 or 20% higher if you wait for the calmer period. So certainly if that's what suits the situation, and particularly for longer term investors, that could be a sensible approach. As I say, one of the keys to long-term successful investing is capital preservation. And if that's the major concern for an investor, then it might well be worth waiting for a calmer time before coming into the market. But all investors should bear in mind that relationship between risk and reward, and in thinking about whether it is time to enter the market right now. One of the concerns or risks we should be aware of when investing in China stocks is a very good question. I mean, there are so many risks in investing in Hang Seng stocks that are the same as investing in shares around the world. And as we've discussed, that higher reward potentially on offer in share markets is largely a function of the higher risk involved. So investors should always be aware of it. But of course, there's many tools available to investors to deal with market risk. And of course, one of the keys is diversification. And diversification is available to every investor. There's plenty of opportunities to spread across a market and spread risk across individual companies. That's also true of countries. So it's possible to, these days, to invest around the globe, spreading your risk between different countries. So diversification is a tool that every investor can use to help manage risk. Nothing eliminates risk without eliminating reward. So, that idea doesn't really work in the real world. The reality is, to gain rewards, we must take risks. So the specific risks, I think, would be that the authorities don't deliver on the stimulus package. I think that's very unlikely in my view. The other major risk, though, is that a global macro factor could derail the global outlook without actually affecting the economy or markets, the economy or outlook in China. And if that's the case, the reaction from global investors will often be divorced from the actual economic outlook. That is, when things get tough, when in markets we're seeing losses and we're seeing defensive behaviour, people often move towards their home country without any regard to the countries they're moving out of. So if there were a crisis in Europe or an extreme war situation in that part of the world, then we could well see global investors pulling money out of international investments, regardless of what they think of the outlook for that country. So, but these are the concerns that we face everywhere as share investors. I don't see specific risks in China that are not present in other markets. I think it's a very similar market in that respect. And of course, our familiarity with and long-term sort of relationship with Hong Kong trading means that these risks are very familiar to most investors. Which market sectors will benefit from stimulus the most over the long term? Well, that's a very open-ended question, and I don't think it's one that can fairly be answered. People can have opinions about that, but the reality is that we've got no way of knowing the future. I thought the reaction in buying the brokerage stocks was an interesting one. It harks straight back to the pandemic experience, where in that initial run-up from the lows after central banks around the world launched what appeared to be coordinated stimulus efforts, we saw that big run-up in the markets, and a big part of that was those trading stocks, those brokerage stocks. So I think that harks back to our most recent experience with this kind of market. I think, though, over time, though, people will delve more into the economic nuances of this particular package, and we're likely to see a shift in thinking about what are the most beneficial. But for mine, when I'm trying to answer questions like that, I try to think about what has underperformed and what is underheld, because in percentage terms, to my mind, that's where the biggest opportunities are. Now, sometimes stocks and sectors are underperforming for very good reasons. And so it's not a given that an underperforming and underheld sector will become a top performer. But if there's potential for a shift in thinking, then there is potential for that sector to lead. Now, I know the consumer sectors have already been highlighted. I would argue that it's the resource stocks that are underheld and have been for a long time. And that would be one of the sectors. It is one of the sectors that I'm looking at very carefully. Would you still invest now, given many Chinese stocks are at highs? Well, excellent question and a good call, something we've obviously been looking at for most of this presentation. The reality is, though, it comes back to that question of risk reward. The answer to the question, would I invest now, is yes. But whether or not you should invest is a decision entirely for you. And as I say, I think an examination of our own appetite for risk and willingness to chase rewards is an important part of the decision for every investor, whether or not it's right to invest in Chinese stocks. In my view, this stimulus package, given its historic nature and the commitment already demonstrated ahead of a potential announcement of further commitment on Saturday, means that this is a good time to be looking very hard at Chinese stocks and Hong Kong listings. So my answer to that would be yes, I do think it's a good time. But as I say, that will depend very much on each individual situation. So thank you for joining us tonight. We'll wrap it up there. Please send through any more questions that you have. Happy to deal with those. Or come to the platform and join the discussions with your fellow traders and investors and seek their opinions and give yours. Thanks for your attention tonight.